and welcome to our Samvat 2081 Market Masters special. It has been a sobering October. As we ride into Samvat 2081, the Nifty is down 7.5% from its all-time highs 1 month ago, but it is still trading at nearly 23 times FY25 earnings. The Q2 earnings has also been marked by slowdown at the bottom of the pyramid. MFI, FMCG companies are showing that pain, but EMS companies, private banks have all been a picture of strength. Latest Vahan data also showing two-wheeler sales at 12% is positive. So how will Samvat 2081 pan out? We have two market masters, Neelkanth Mishra of Axis Bank and Sivaram of Enam Holdings. Let's start with Neelkanth. Neelkanth, thank you very much. Happy Diwali to you. Well, first up, how much is this slowdown? I mean, we saw GST collections only at 6.5% compared to a nominal GDP at 11%. So is this a serious slowdown or seasonal?
I think the economy has slowed, and this is something we've been flagging for a while. For a while, people thought it was just the intense heat or the elections, and then it was heavy rains. But no, we have to face reality. Most high-frequency indicators have slowed very sharply. And so everything from cement volumes to power volumes to car sales to CV sales to, I mean, you name it. I can't think of any high-frequency indicator which has actually improved in the last 6 months. So
I'll show three
okay.
pieces to counter, to play the strong advocate. Vahan data is now available for the first half of the festive season. And there the two-wheelers are up 12%, a damn good number. Not PVs, passenger vehicles are still flat, but two-wheelers at 12%. And the other data, the core sector data for September that came out, cement alone has done well, though it has had a very bleak
1.7% or something, so I don't think, see, remember that.
Not good enough.
Cement was growing at 11-12%. This is an investment-driven recovery. If the GDP has to grow at 7, cement has to grow at 9-10. And so it is, well, thankfully it is not zero, which is what for the quarter our analyst expects, that is estimating that the industry as a whole pretty much didn't grow. Or even if it is 2 or 3%, I don't think that suggests a strong economy. The Vahan registration, see, I think there are several distortions that can happen if you only look at 15, 20 days of data. The bigger picture is that the car market is a much bigger market than the two-wheeler market. From an overall economic perspective, I think even the credit impulse is down, right? So credit growth had slowed below 13%. So I think on a whole range of parameters, the economy has slowed. The question for all of us is this a temporary slowdown? If it is a temporary slowdown, then we should be buying into the weakness. If it is a much longer term slowdown, then it is better to book profits and stay out for a while. I think it is the former. Of what I call unintended level of fiscal and monetary tightening that the economy has slowed down. We can see that corrective action is underway. And my expectation is by maybe Jan, maybe Feb, the high-frequency indicators should start improving.
Okay, so you're saying that the lack of expenditure in the first 2 quarters by the government meant less fiscal impulse, and the Reserve Bank's liquidity, tightening, not so much rate, but liquidity, yes, which is considerably loosened in the second quarter. Those two will create growth in the second half?
Yes, and I want to spend maybe an additional half a minute on the liquidity side. So it wasn't just the RBI keeping liquidity tight. It was also, I think, the discomfort it had on the high loan deposit ratios, and which were communicated to the banks in March, April, which meant that we pretty much triggered a downward spiral. As you know, deposits are created when loans are given. So if the banks start cutting loans or slowing down loan growth, it slows down deposit growth, and then the whole thing sort of goes into a downward spiral. So if you look at incremental credit impulse, that is FYTD, what we have done, the growth has been far lower than what we saw in FY22 and 23, and in 24. So therefore, I think that has had a very significant impact on the economy as well.
Oh, yes, and perhaps it was called for, at least in areas like microfinance and unsecured credit.
I'm not so sure that, so see, we have to be very clear on this, that while there were possibly excesses emerging in small buckets, see, there are broad brush tools. So there is, CRR, SLR, overall credit growth, LDR, LCR. But then there are these narrow buckets. So if unsecured personal loans are, say, 7-8% of banking loans, or the MFIs are all put together, maybe 4 or 5% of aggregate loans. If those have to be targeted, and it is perhaps required that there be a slowdown there, then the tools have to be different from an aggregate credit slowdown.
Okay. Now, to be fair, they did do macroprudential rules, like, for instance, they increased the risk weight on unsecured debt. They did not raise rates nor squeeze liquidity out. But Neelkanth, therefore, what is the take?
Squeezed out. No.
Yes,
See, let's be very clear on...
Liquidity was squeezed out in August, Neelkanth, and that was because last August, food inflation went to 7.7.
No, not August. See, the fact that food inflation is very high, and that makes the MPC's job very hard, given that there is now evidence coming through the economy is slowing, but the headline inflation that they need to be targeting is still elevated, is, I think, a very complex problem. I don't think we should underestimate the challenge. But the liquidity tightness and the fact that the central bank created a share, or so the M3 share, as you know, broad money, there are only two entities that can create: commercial banks and Reserve Bank.
Yeah.
The Reserve Bank share of incremental money injection in the last 2 years was 14%. It tends to be about 18 to 20%. Now, what we have seen since July, because RBI has started to ease on that front, I think clearly seeing that problems are emerging. And now, the banks then take time to understand that this is the signal. And with the stance changing to neutral in October, I think incrementally things are easing further. And my expectation is in the next couple of months, even the banks that are still, I think it's a lagged response to the liquidity tightness a year back. There's still a rush for bulk deposits. The rates are too high. Some banks are still holding liquidity. That may not be necessary. So as the banking system understands that the RBI's liquidity stance has changed and has changed for good, I think that's when the credit impulse starts to improve.
Okay. So how do you play this in the market? Do you buy the dip? And when you buy the dip, which dips? Which sectors?
So because the flows were happening. So remember, because now that we are moving to the market, so let's put things in context. We've seen FII selling continue through all of October, right? So we've seen about maybe $11 billion maybe go out. And this is a very, very strong pace of exit, meaning that just 7-8 years back, $15-20 billion of inflow in a year used to be a very good inflow. Now we are seeing $11 billion go out in a month. And while domestic flows, I think, have been largely steady, there may have been some HNI numbers, which we'll see in a couple of days, but on the EPFO, SIP, insurance, all of those flows are give or take $4 or $5 billion a month, which is a lot, but it's very small compared to $11 billion of outflow. So if you see that pace of outflow, the market will take a breather. Now, which sectors to prefer? From, I would say, April, May, June onwards, there was a move to defensives. So IT, staples, pharma had outperformed significantly, despite the fact that for some of these sectors, IT and pharma, the earnings were still getting cut. And this was, I think, the fund managers responding to the high frequency indicators slowing down, but having to cope with steady inflows. As we start to see a cyclical recovery, so you talked about private banks doing a bit better, because clearly for the banking system as a whole, the challenge over the last 2 years has been that on the quantity side, the raw material that the banks work with, that had started to become a problem.
Shrink.
And therefore, as we start to see that raw material improving, and at the margin, the deposit pressures, the deposit rates should start to ease because the quantitative side we are starting to ease. I don't expect rate cuts to happen, by the way. I mean, I don't think there'll be room for rate cuts till February or April. April may be the earliest that we should expect. But on the quantitative side, I think things will start to ease, and that should definitely help the banks. I expect, and we saw some order books from the large industrial companies yesterday, at least surprise on the upside. So the capex cycle, at least so far, seems to be intact. And as the cyclical recovery happens, those would be the sectors that I think will benefit more.
Okay, not consumer discretionaries, EMS companies. EMS was good. I know it's a small sector, but it's doing well.
Yeah, it's doing well. And I expect, I'm part of the India Semiconductor Mission, and I'm actually seeing it from close, very proud of what the country has achieved and the momentum that we are seeing, not just on the...
So your bets are on capex and private banks. Okay, thanks, Neelkanth. Got it. So private banks and capex are your bets. Thank you very much for joining us in the Samvat special. We're going to a break, and after the break, we're going to be joined by Sridhar Sivaram of Enam Holdings.